Okay, good evening, everyone. Welcome to our session on chart patterns. So I'm just going to run through a couple of the basic chart patterns and the ones that we see regularly, especially on the shorter term charts. So I'm just going to start with the obvious, which is double tops and double bottoms. So the rules on chart patterns are reasonably straightforward. So for a double bottom, we need a downtrend. Price finds support and bounces a little bit, comes back and finds support at the same or similar price to the previous support level, and then the market buys the price higher. Now that's in a perfect world. Obviously, it happens very seldom that the price is identical. A double top is exactly the opposite. Uptrend, retracement, retracement, resistance, and break of the neckline is considered the confirmation of that double top or double bottom. And there we go. So those are the basic rules. So the first requirement is it has to have a trend. It has to bounce or retrace, and then it has to find resistance or support. It retraces or bounces again, pulls back to the same price level, and then fails to break through that price area. So one of the big mistakes. Okay, let me try this again, right? So chart patterns have very specific rules. And what happens as we trade in is we often forget those rules or we misname something. Price doing that is not a double top. Okay, that would just be resistance. Now, for ease of communication, we just call it a double top. All right, but if you're trading end of day charts, you can't call that a double top. It would just simply be a resistance level. There's no prior trend. Okay, so that's not really a double top. We need the prior trend, support, bounce, break of neckline to confirm. Now, on the short time frames, if we wait for that neckline to break, we can often give away quite a large number of points. So what we often see in these areas are the candle patterns that I discussed over the previous two sessions, and it requires the initial support level. Then we get a bullish engulfing pattern on that support level as the second low. So that's yeah, it's quite a nice way just to confirm it. I'm going to go to the charts now and show you how we draw these things on candles. But the whole idea is prior trend, support, neckline, break of neckline, confirm the double bottom. For the double tops, it would be an uptrend, resistance found twice, neckline is broken, price drops, and we then confirm that as a double top. Now, if you are interested in chart patterns, I mean, it's a study on its own. Chart patterns, candle patterns, they kind of all fit into their own little categories. Thepatternsight.com has a great free resource if you are interested in really getting down to the technical stuff. I'm not going to cover the really technical things. That would take us hours and hours. But just to give you a basic idea, when we're talking about a double top or a double bottom, this is what it's supposed to look like. And for ease of communication, we would also call that a double top. So that's the first, those are the first two patterns that I'm going to look at. The next one would be the head and shoulders. All right, so head and shoulders, bullish head and shoulders requires the downtrend, a retracement, a break of that previous low, a retracement, and a failure to hold above resistance, another retracement back to the previous support level. All right, so that's what a head and shoulders looks like. In the perfect world, that would be a horizontal line. The confirmation will come with a close above the neckline. Bearish head and shoulders requires the uptrend, retracement, break of resistance, retracement back to support, and then back to left shoulder, right shoulder resistance. Now, of course, there are variations to this. we can get the low, we get the head break, and we get a slightly higher neckline over there, and we get the higher right-hand shoulder over there. This is the least tradable of the head and shoulders patterns, because simply to wait for that neckline to break, you're getting in well off the well off a really good entry. On the upside, or different variation of that, would be something that looks like this. And we have the rising neckline, and we have the higher right shoulder above the left shoulder. This is the most tradable of the head and shoulders patterns because you're getting in very close to that turning point. So the neckline then becomes really important. A rising neckline and break of that, we get an earlier entry. On the bearish head and shoulders, obviously on the bullish, it would be slightly different. It would be something like that. And we're going to get the trend line break much earlier than we did on this pattern. A head and shoulders, to be a proper head and shoulders, requires the prior trend. So we do need that uptrend, and we just need that little retracement. Now, those of you that have done things like the ABCs with that, you should be able to see that this is now just a variation of an ABC pattern, and it just repeats, over time. Now, we see a lot of head and shoulders, especially hourly charts on the indices. And obviously, end of day, they are a little bit more rare. Just simply the amount of time required for head and shoulders to build on a chart end of day is considerable, and we just don't see them these days. Markets move too quickly. Things have changed within liquidity and all the rest of it. So the time taken for these things to form has certainly shrunk. So what we do get is we get a lot of small head and shoulders, and we would get something really like that. And it's just slightly off the head and the trend line. So a lot less time taken to build the pattern. These very wide, lazy patterns don't occur as often as they used to. All right, so that's the head and shoulders. If we have a look at the next one, rectangle tops and bottoms. Basically what happens is you have a support line, you've got the previous low, and we call it range. Now, ranging markets tend to last a lot longer than a rectangle top or bottom. All right, so a rectangle bottom would be something like that. You've got your trend, you have the little consolidation going on, and it's nicely horizontal, preferably parallel, and the market then breaks out reasonably soon in comparison to something that is totally in a major consolidation there. So rectangle bottoms are only confirmed when the price breaks above the resistance. And the same thing on the upper band. We get our little zigzag going there, and we get a nice parallel line, preferably parallel, like that. And we get the rectangle top. Now, this pattern has two options, right? So a rectangle bottom is only a rectangle bottom if price breaks to the upside, and a rectangle top, vice versa. Rectangle top is only a rectangle top if the price breaks lower. What we do get is often continuations. All right, so we get the A, B, and C break to the downside, and then that would just be considered middle of the trend, and the expectation would be that that distance there equals that distance there. All right, so it does depend which side it breaks. Rectangle bottom versus rectangle continuation. I mean, these are reasonably simple to see when you draw your support and resistance in, and the price breaks either side of that. It's pretty straightforward. If it's a lot longer or a lot wider, so if I have a really wide consolidation like that, yeah, that's more a range than it is a rectangle top or bottom. And chart patterns are very much reliant on the amount of time that they take to build versus the amount of time that occurred from the previous low to high on the trend. So if that distance there is, let's say, 2 days, this consolidation shouldn't last longer than 1 day. Otherwise, it gets out of balance and we start getting the range. So rather than a rectangle top or bottom, that would then become a range. Okay, and then we have rounding tops and bottoms. And these are also very specific. We have a trend, and you'll see it on the candles. We end up with something like that. So I'm using a line chart here, but you would see it on the wicks. And then we start to get the higher lows, and the market does the zigzag. So you can see that it's not convinced of the downtrend. It's also not convinced of the uptrend. And we end up with something that kind of does that. Now, I was going to take these two circles out there, and we're going to look at the neckline. So when it comes to any consolidation type trading, we have something called a shelf. So it's an internal shelf, it would be resistance within the pattern. So if we look at a rounding bottom like this, the neckline would be somewhere over there. That would be the internal shelf. And the neckline itself would actually be the beginning of that consolidation. So neckline is drawn across the top. The shelf is drawn on the inside of the resistance that forms. You might have some wicks and candle bodies in there. Internal resistance, it breaks that. That would be considered trade 1, and trade 2 is a break of the neckline. And obviously, sometimes they're the same thing. We could get, long wicks all the way up to that neckline. That's even better. That just really shows when that breaks out and closes above resistance, we have ourselves a really good trading opportunity. And on the upside, same thing occurs. We get our neckline or our shelf over there, and the market is zigzagging in between, but it's always making it makes the higher highs and then it makes lower highs, but it doesn't have a wide range. So you won't see, rounding top and the price is doing all sorts of zigzaggy things like that, because there's no neckline. So how do you draw your support or resistance? So even though it is a rounding top, technically, it's not tradable. So it is quite important to be specific on these things, and you are welcome, of course, to send me pictures to get through it. So rounding tops, rounding bottoms, generally speaking, they are very reliable patterns, especially if they form with a nice tight range there, and we can put a nice little circle through the wicks. And sometimes we have to actually change to a line chart to see it clearer, where the candle bodies actually provide the rounding rather than the wicks. I don't want to get too technical tonight. Look, at the end of the day, if you're interested in the technicalities of these things, give me a shout and I'll actually, we can just work one-on-one through the absolute technical side of trading with chart patterns. Oops, now I've done something. Give me a sec. Just supposed to go. There we go. All right. Okay, so what I thought I'd do is I've just picked a chart. So this happens to be $R 5 minutes. And I want to go through this chart, basically how you're going to see the market when you're trading. Okay, so I've just taken this all the way to the left. I have no idea what the data looks like. Immediately here, we can see resistance. Okay, so on candles, if you remember the candles lesson, we had it on the highest body and the highest wick. Time passes, price finds resistance. That can only be classed as a double top if there was a long prior trend. This is not a trendy, this is not enough of a trend for me to call that a double top yet, or at all. All right, so I'm just going to remove those lines and we're just going to go to the right. Okay, so there we have support again. Now it is a 5-minute chart, so these things occur all the time. There's our bullish engulfing pattern. That would be more important than that total mess over there. We can just see time of day also makes a difference. But I've taken the separators off so the patterns are clearer. All right, so we've got the bullish engulfing. We would put our support on the bullish engulfing pattern, and lowest body, lowest wick. The market pushes through, back above, false break to the downside. That is not a double bottom. Okay, fat bullish engulfing over there, and just time goes by. There's no candle pattern over there. Is it resistance? Well, we've had the retracement, so if we're looking at it and this candle was live on the right-hand side, we could say we have resistance over here, and we would just put our little resistance lines in and see what the market does after that. Straight through resistance, no double top. No rounding top, there's no chart pattern at all. And the market carries on and on and on it goes. Nice little candle continuations there. Let's just move these up so I don't lose them. And we have an evening star there. So that's rather important. Bodies and wicks. And we have a little rejection of the high there. A little doji form here. It's not really a candle pattern of too much note. Maybe a little tiny shooting star or whatever. If this is a double top, then the neckline would be the support. Do we have a prior trend? Yes, the prior trend is pretty clear. So we've got that trend in place, and we have currently got a potential support level there for a neckline if that is a double top. All right, so there we have the variation of the evening star, two dojis in between. I class that as a double top. It hasn't really closed above that resistance properly. And if I put that line on the wick, you can see it didn't really close above the line. That is considered a double top. All right, so we have the evening star. We don't have a solid close above. I would consider that a double top. To confirm, it would need to break the neckline. We do have the variation of the evening star pattern there. And if you were trading with stochastics or whatever else, whatever other strategies you were using, that could be used to confirm the idea. So there we have the stochastic topping out. We have divergence there, and that stochastic is warning us that momentum could be draining away. Now, what I would be looking for is an internal shelf, which I have by using those two, the bodies of the evening star there. Sorry, that's going to jump automatically there. Let's just bring it up. Goodness, okay, it's just going to keep doing that. All right, so that would be then the internal shelf of that right side of the double top. Market breaks below the evening star, entry number 1. Entry number 2 would be when price breaks through the neckline, and we have 2 trades in, one on the evening star candle pattern, one on confirmation of the double top. If you were long, that is certainly a reason to exit the trade. If you've got a nice trend going there and you hit the double top, off you go. You can call that quits. All right, so time goes by. Let's see what else we can find on this chart. Okay, there's a rounding bottom. We've got the prior trend, and we've got the lower wicks, and we've got the rising wicks. Bodies look like they're forming support. Okay, so there's no close below those bodies. Nice little rounding bottom chart pattern there. Neckline in place over there. So that's the neckline, internal shelf. A little bit aggressive if you're going to go long on those small candles, but certainly after that, it was a nice little break to the upside. Where's our stop losses? Because that's really the most important thing. Well, on the double top, the stop loss would have to be a close above the previous high. So the stop loss would have had to be up there if you were trading it short. Obviously, if you were exiting a trade, it wouldn't matter. On the downside, it would be a close below the low of the rounding bottom. Or if you are a little bit more skilled and you've been doing this for a while, a close below those bodies can also be seen as a confirmation of a failed pattern. You can always trade again. Okay, so there we've got the resistance is still in place from that double top. That hasn't touched yet. Right, now it's closed above resistance. I'm going to just delete the lines. So that little rounding bottom there, that worked out quite nicely. And again, if you were trading a stochastic, it's well oversold. If you're looking for ABCs, ABC, double bottom again, and off we go. That is still considered a double bottom. You've got the trend and so on. But yeah, I don't want to get too carried away because I can for hours. And I have an evening star pattern here. I simply move my resistance to that evening star. Forget about the history here. Is that a double top? Oh, there's an interesting one. So if I go back, I've still got that nice long uptrend. That double top could be in play over a longer time frame. I'm not going to go changing time frames here, but on maybe on the 15-minute chart, there's a nice double top there to trade. Where would you trade? Well, the rules don't change for that. Simply a move through the lowest body, close below, break of that low would be the entry short. And we've got the double top there. Confirmation would have to be a break below the neckline. So I think the bottom line is here, you can see that chart patterns occur all the time, and they don't always work. There's a shorter period, double top again. Stop loss, closed above resistance, closed above the wicks, whichever one you wanted to use there. And so that would be called a busted pattern. There are times to trade it, but I'm not going to go into that. That's a little bit on the advanced side. So we're just going to leave that. That was stopped out. That double top didn't work out. Nothing wrong with that. And there's no short trade going on there. I've still got support, neckline break. So if I was looking at that longer term double top there, neckline break, and this is occurring at 11 o'clock at night. So whether you would have been trading or not, I don't know. And you would have been stopped out on the gaps. All right, so let's get the market. Well, let's go and have a look at something that most of you will be familiar with. So I've got the Dow 1-minute chart open. Now, as by now, if you've traded for a little while with us and you've been watching these 1-minute charts, you see lots and lots of support and resistance. So you hear Pat often say things like, we've got double bottom, double top. Be careful of those fib levels and so on and so forth. And I haven't got the fibs on here because it's just not part of this particular lesson. But if I take that area there, okay, and I put my support on the body and the wick, that is considered a double bottom. All right, but it isn't really, because there's no massive downtrend that complies with the amount of time that passed between the rise and fall back to support. Essentially, this is still range bound. It now becomes a range. Now, I can tell you now that we would be calling that a double bottom. In reality, it is support, not technically a double bottom. A double bottom requires a proper trend. The same thing as we'd be calling that a double top. And if we go back, you can see it's range bound. That's not really a double top. But we would call it such simply because it's easier than trying to separate support, resistance, double tops, bottoms, rectangles, all that stuff. We tend to just call them double tops. I call them resistance, but I don't trade 1-minute charts, so you won't hear me online. And that again would be called a double bottom. Technically it isn't, but it doesn't really matter because the principle remains the same. If it doesn't close below that support line, then if you are short there, that's the area you're going to be worried about, especially when you start putting your fibs and things on these charts. Right, so what happened then over time is that consolidation went on for quite a bit of time there. And we can just see, so we had all those chart patterns in between, but really the price really went nowhere. Now there's a lot of trades in there. So we had the rounding bottoms, we've had the double tops, double bottoms, but essentially the market's gone nowhere, but we've had quite a few trades. Now, at a quick glance, we look at this picture here, we can see double top. So it's quite clearly A, B, C, and double top. That would be considered the end of trend. There it is. And that's a really nice one. I just want to get the wicks in there and zoom in a little bit more. And there we have, so we've got that nice swing, retrace, swing, retracement. So A, B, C, double top, and it's confirmed twice. So essentially a triple top, but not enough of a retracement here really, but still triple top, that's fine. Strong resistance there. Break of neckline is confirmation, and look what happens. Market drops off, but it retraces all the way back into that area again, which is why if you are going to trade chart patterns, you have to become really good at trading the initial pattern, and then the necklines become longer term holds. So the stop loss would have to be at the top there. You're going short on a close below that support. Let's just bring that down. That's the neckline there. And we've got close below support. You're going short over there. Stop loss up at the top. And that retracement back into about 50% of the range. If you take a little fib there, top to bottom. Okay, not quite 50%, back to 38. And then off she went. So you would have had to be really disciplined to trade the break of the neckline and have your stop loss up at the top. And if you do your risk properly, then that's not a big deal. But you know, your size has to be in proportion to your risk. All right, and the market continues to drop. Let's just clear this up here, and we go through, right, variation of a double bottom. Okay, now this is basically called an Adam and Eve double top. It's got one or two spikes there, and then it's got a whole lot of spikes in between. So that's more of a flattish pattern, and that's more of a spike there. Bulkowski calls it Adam and Eve for obvious reasons. And this here is now called just an Adam and Adam. It's just got the two spikes. The double bottom is in play. If you were short, you would have had your lines in like that. If you were short, that is now confirmed double bottom. It went below the body, but not below the wick. And we have an exit for our shorts over there. So if you went short on that double top, break of neckline, retracement all the way down, breaks lower, breaks through that low, retraces back up, pulls back, failure to break lower, double bottom is in play, exit is handled. Now, what we don't see a lot of, excuse me, at the moment, we haven't seen any head and shoulders yet. Wrong button. There we go. And we haven't seen rectangle tops and bottoms, so I'm going to keep an eye out for those. So if you have any questions, now's the time to ask on double tops, double bottoms. While I look for these other patterns, you're welcome to just switch your mic on and give me a shout. Okay, let's get rid of the evening data. There we go. So there's an example of a rectangle. This particular one didn't work out too well. But that's the idea. Our bodies are all even. I generally ignore the wicks for these types of patterns. The market broke lower, failed to hold on to the low, broke above the high, and didn't hold on to that either. busted pattern, double busted pattern, and eventually it worked out to the downside. But there's no way you would have been holding on to that, right? Okay, example, double bottom that failed. Didn't close above the neckline properly, or it didn't get above the wicks. And that double bottom failed to bounce. So they do fail. None of these things work all the time or every time. I'm really hoping to see a head and shoulders. Let's change to an hourly. All right, so the first thing we see on hourly is the whole picture changes. All right, so your time frame is important. 1 minute time frame, you've got maybe 10, 15, 20 minutes, maybe half an hour on a 5-minute chart that you're going to have the patterns work out. On the hourlies, it can be days. So the first thing I see here is a head and shoulders type pattern at the bottom. Okay, now there's the trend, and it's deep enough. We've got the left shoulder, we've got the right shoulder, we've got the neckline almost even. So if we get technical, so I didn't push the right button. Take the bodies, take the wicks, tiny little thing there, and I'm just going to leave it on the wick of that first neckline. And then we had the little right shoulder there. We had, sorry, left shoulder there, and we had a little spiked right shoulder here. Now, honestly, there's no ways I would have traded that as a head and shoulders. But if I was short, this would be a really good area for me to look for stops. Okay, so trail stop, maybe you short from up there, strong double top over there. You're still holding, you see this little head and shoulders, strong reversal pattern. Not a great one to trade long, but certainly to exit the shorts, it would have been fine. And straight away, we see another double top. And this goes on forever. Double tops and double bottoms are really good tools, especially if you're exiting and you're in a good profit. Okay, what I'm trying to find is a really good head and shoulders. I'm sure that when you trade with Pat, I don't know if he uses them as often as he used to, but he used to use them quite often. Okay, let's see. There's another example of a variation of a head and shoulders. Price basically remains within a bit of a range on the neckline. Left shoulder to right shoulder. Doesn't really pull back. Not a very good head and shoulders, and looks like that didn't work out. And straight back to double bottom. Triple bottom, rounding bottom coming through there. Higher low, and bang, it all fails. Okay, so just because there's 3 good support area levels doesn't mean that the market's going to do anything. You would have to follow your trading rules to do all of that. There must be head and shoulders here somewhere. Let's see how we go. Oh, and we're at the end of the Dow. Off to the Nas. Just turn off there, and let's go and have a look. All right, so there's a head and shoulders type pattern. Left shoulder to right shoulder. We've got the head over there. We've got the neckline over there. Pretty solid support level. And there's the trigger short, and off we go. And then back into the zone. Once the pattern is over, it's over. Delete the lines, unless they are, of course, support or resistance going forward. But once the pattern has made its move, it's done. Now, target on head and shoulders. I use a simple formula. I take the distance from the head to the neckline, and I go 161 extension. And that's my exit there. So if I can get short on that bearish engulfing or that bearish engulfing, I would rather do that than wait for the close below the neckline to make the trade. So I want to get in early. I consider that already double top type thin resistance. That actually could be a little bit of a rectangle there. Not a great one, but certainly getting short over there is better than waiting for the break below the neckline. Especially when the break is right near the target. If you did wait for that, you wouldn't take the trade. Your risk reward is terrible. your reward is 50 points and your risk is at least 140. Okay, there's a nice one. So there we have our downtrend. There we've got a really solid head and shoulders. Put the lines in to confirm. Left shoulder, right shoulder support. Neckline's a little bit elevated. Not too bad. Wicks through bodies, or if you wanted to go body through body. Break above, closes above, long over there. And neck, remember what I said? Neckline to the head. So not from that spike or anything like that. Vertical line from the low onto that actual neckline. 161 extension over there. And there's a good few points in that. 74 points. Hourly chart, yeah, a little bit weak, but maybe you converted that to a longer term trend trade or whatever it is. If you go down to a 5-minute chart, rounding bottom over there, little spike below, might have kept me out of that one. I haven't seen any rectangles. Dylan, if you see a rectangle, just shout. All right, so there again, double top, sorry, and double bottom, and you can see those just about every week. Okay, there's another head and shoulders. Now, if you are keen on chart patterns, that's one thing. Okay, if you're keen on chart patterns and you actually spend the time to study them, work with them, trade them, that's totally different to using them as a guide based on what else you're looking at. All right, so if you're using our intraday trading systems, 5-minute chart here, daily high lows, weekly high lows, monthly high low, all that type of stuff would take precedence over the chart pattern. Same as candle patterns, they must occur or should be used in conjunction with your other strategies. Chart patterns on their own, yeah, I mean, I've traded them for years. I love my chart patterns, but I just find these days algorithms are picking them up and kind of ruining them to a large degree. And you can just see the spikes through here. Yeah, these used to be really clean patterns. They would come out, nice little double bottom there, a nice little right shoulder, and off it would go. These days, the algorithms look for that kind of pattern, and they basically trade the market out of them. But if you were looking short here, maybe that's a daily high-low trigger, maybe it's a weekly high-low trigger, and you see the head and shoulders over there and you get your trigger here, it should help you feel more confident of your position. And that's really what we're after here. I'm not teaching you to trade them. I'm not really giving you trading rules for them as such. Basically just a look and feel as to what they look like. So there's another little double bottom. We've had a strong price drop, small little double bottom there in time. That's good enough for that little price drop, and we should go at least 50% back, and off it goes again. All right, have I missed anything? Okay, the running tops and bottoms, we haven't seen too many here. So there's another little rounding bottom type pattern, another little rounding top. I mean, these are great trades. You know, even if you're just trading support and resistance, you can actually see that rectangle top there, and the break just below that support. So a solid little rectangle top there, breaks below support, and off it goes. And if that was your 38 trigger short on the 38 fib or something like that, that is a really great pattern to push you in the direction of the trend. Let's have a look on daily charts. So there's GBP US dollar. I mean, these things work on any price chart. Even coffee, which is terribly illiquid, but the patterns still are still effective there. So what we see on pound dollar is 1, 2, 3, 4 months to form a double top. You've got a solid rising market, decent neckline, decent resistance tops over there. If we zoom in, do we see anything on the candles? Let's have a look. So bearish engulfing there, nothing really over here. Still a decent solid double top, didn't close above resistance. Break through the neckline. That was a pretty solid trade on the currency pair. Double bottom going through there. There's got to be some rounding patterns here somewhere. There we go. So there's a nice rounding top. If we take a little bit more time, we can see the double top over there. So we've got the Adam Eve double top. This is a real proper Adam Eve double top. We've got the spike high on the left. We've got the rounding top on the right. There's a little spike there. That candle's in the resistance zone. That's a solid rounding top. We have a very good internal shelf over there. Break of that, that's trade number one. And into the trend if you're into trends. If you're into the breakouts, that simple move there, yeah, it's 300 points on 300 pips on pound dollar. That's a pretty decent trade. There's a type of rounding bottom over there. Can you see how this is more zigzaggy than that? So this is the ideal rounding top type pattern. This is a terrible rounding bottom. It's just got too many spikes on the upside. You could have put resistance in there. You can see momentum just didn't follow through to break through the double top. All right, so there's another double top, similar idea. Adam Eve double top there, didn't follow through, didn't reverse the trend, and you would have been stopped out on the trade if you were just trading with the chart patterns. So hopefully what came through tonight is that the chart patterns are complementary to everything else that you're doing. If you are buying off support or selling at resistance, the chart patterns are helpful. If you're trading breakouts, which is generally momentum trading, which is what you're doing generally on the 1 minute and 5 minute charts, that short-term momentum can be confirmed by previous chart patterns. So you get a short signal over here for whatever reason, monthly high low, could be a 5 minute chart, could be the daily high low triggering here, and you can see the double top going through, and you can see the rounding top. That's a nice feeling for that trade to push lower. If you were in a long-term long and you see the double top failure to hold above that neckline, that's an alternative way to exit at a profit. Now, obviously, there are many chart patterns. I haven't seen any cup and handles today, but you would have come across those reasonably regularly if you subscribe to anybody's technical analysis newsletter. So cup and handles and flags and pennants. And flags and pennants used to be my favorite trading patterns, and we just don't see them anymore. It doesn't really matter. There you can go back 2017. There's a nice little flag pattern, and that worked out. There's the cup and handle. So it literally looks like a teacup up to the neckline. Retracement should be 38%, and then breaking through to move higher. So yeah, chart patterns are, I can't remember off the top of my head, there's about 30 odd recognized chart patterns. And if you use a line chart versus a candle chart, the patterns are slightly different. So you can see, oh, that's a terrible color. Let me just change that. Colors. Sure. You see, I don't use line charts very often. Let's just use a dark blue. Okay, just delete that. All right, so there's head and shoulders, which is not very clear on the candles because of the wicks. So left shoulder, the head slightly lower, right shoulder, nice downward sloping neckline. And just the close above that would be the trigger with a stop loss below either the right shoulder or the head. So the line chart does change the look and feel of these patterns. Sometimes double tops and double bottoms are not double top and double bottom on the closing price. So line chart is just simply closing price. And that's that great double top that we saw on the candles, but with the line chart, it's not a double top. So yeah, the trick is to kind of pick your chart style and trade what you see on that particular chart style. All right, if there's no questions, you're welcome to switch your mics on if you want to. All right, well, I hope you found that interesting and informative. You're welcome to send me questions. And again, if you do want to get technical with chart patterns and get all the actual trading rules in that, contact me and we'll set up a bit of one-on-one time and I'll give you some of those rules. Things like busted chart patterns, targets, stop losses are easy, obviously break of support or resistance. Targets on the fibs, neckline 161. If it breaks that, you can go to the 200 and so on and so forth. But yeah, so I'm not going to carry on there. I hope you enjoyed that. And I will be putting something together again for next week, Thursday. I haven't decided what I'm going to talk about yet, but there will be something. So trade safely and contact me if you have any questions.